In the 6th century BCE, there was this Greek philosopher named Thales. He lived in Miletus, and he basically bought up the rights to every single olive press in the city during the dead of winter.
Which, sounds absolutely insane.
Right. It sounds like a terrible investment until you realize he had essentially just invented the modern futures contract.
It's just such a brilliant historical anecdote because he used his knowledge of, well, meteorology to predict this massive record-breaking olive harvest for the following autumn.
Yeah, so when the presses were just sitting there completely idle and super cheap in the winter, he didn't actually buy the heavy wooden machines themselves.
Exactly. He just paid a really small fee for the exclusive right to use them when the harvest finally arrived.
And then months later, the bumper crop hits. The entire region desperately needs to press their olives, and Thales controls the entire capacity. He rented them out at a massive premium and just made an absolute fortune.
He locked in a price for a future event. I mean, he managed his risk, and he speculated for an incredible profit without ever actually owning an olive or a press until the exact moment he needed to.
Okay, let's unpack this. Because while Thales was, cornering the local olive press market, that fundamental logic of trading the future has mutated into this invisible $699 trillion engine that powers today's global economy.
Yeah, that number's so large it almost stops making intuitive sense.
It really does. So, for you listening, our mission for this deep dive is to demystify the complex plumbing of this market. We want to understand how new technologies are pushing this system to a relentless 24/7 pace.
And examine how sovereign nations are frantically trying to write the rules for what is basically a borderless financial powerhouse.
Exactly. And to do that, we have a really phenomenal stack of sources today.
We do. We're breaking down a recent press release from Bloomberg about their new global commodity indices, and we're pairing that with a massive global legal guide. It's called Derivatives 2025, put together by the legal experts at Catton Muchin Rosenman LLP.
Yeah, so the Bloomberg release is going to give us this real-time snapshot of the hyper-specific products that institutional investors are, demanding right now.
Well, the Catton Guide provides the blueprint.
Yeah.
How these complex trades actually function, how they clear, and how they're regulated across wildly different jurisdictions.
Right. So Thales cornering the olive press market was this brilliant localized hedge. But when you scale that concept to the modern financial system, the numbers get staggering.
They really do. The Catton report pegs the global derivatives market at a 5% growth rate, reaching $699 trillion in notional value.
Which, wait, we need to translate that for a second, because when we say 699 trillion, we aren't talking about piles of physical cash just sitting in a giant vault somewhere.
No, not at all.
Yeah.
Notional value is, it's more like the face value of an insurance policy.
Oh, right. Like if you buy a policy to insure a $1 million factory.
Exactly. The notional value of that contract is $1 million, even though you might only pay, say, a $50,000 premium to actually hold the contract.
Got it. So it represents the total footprint of the underlying assets that these contracts are tracking.
And that distinction is vital. It's the footprint of global risk.
Mhm.
And if you look at the breakdown of that footprint, interest rate derivatives make up the absolute lion's share.
Really? Like how much?
$548 trillion.
Wow. That's just massive.
It is. Because every commercial bank, every multinational corporation, every pension fund, they're constantly managing their exposure to fluctuating interest rates.
Right, because if a bank issues thousands of fixed-rate mortgages, but they borrow money at a variable rate, they are exposed to catastrophic risk if central banks suddenly hike those rates.
Exactly. So they use interest rate swaps to trade that variable risk for a fixed rate, essentially immunizing their balance sheet. And that is the bulk of the market.
Okay, so the interest rate volume is massive, but the Bloomberg press release actually highlights a really fascinating shift happening over in the physical goods sector.
Yeah, Bloomberg just launched what they are calling the BCM Global Commodity Singles Indices.
Which, honestly, when I read that, I thought, why? Like, if a major institutional fund wants a $50 million copper position, why wouldn't they just go buy the physical metal?
Well, what's fascinating here is the sheer logistical friction of doing that.
Oh, like storing it.
Yes, financial investors do not have the infrastructure to handle physical commodities. If an asset manager wants exposure to crude oil or aluminum, they cannot deal with securing specialized warehouse space.
Right, or paying for heavy industrial transport, or, arranging maritime insurance.
Let alone factoring in the physical degradation of the asset over time. I mean, it's a nightmare. So these new Bloomberg singles indices bypass all of that.
Because they track the performance of holding and continuously rolling long positions in individual futures contracts, right?
Precisely. The investor gets the pure financial exposure to the price of the commodity without a single barrel of oil or spool of copper wire ever showing up at their office.
Well, wait, looking at Bloomberg's existing products, they already have their flagship Bloomberg Commodity Index, and that tracks a broad basket of 25 core
We
commodities.
do, yeah.
So why this sudden push for single commodity indices? I mean, buying a broad 25 commodity index just to get copper exposure feels a bit like buying an entire grocery store just because you need a gallon of milk.
That analogy hits the nail on the head. In fact, Jigna Gibb, the head of commodities and crypto index products at Bloomberg, she explicitly notes in the release that investors are increasingly seeking more precise and flexible ways to access commodities.
Because they don't want the whole store anymore.
Exactly. We have to look at the macroeconomic themes dominating the landscape right now. We are talking about massive supply chain realignments, food security crises, and, most importantly, the global energy transition.
Right, because building electric vehicles and massive solar grids requires entirely different materials than running a traditional fossil fuel economy.
Precisely. So if you are a massive fund allocating capital specifically toward the energy transition, a broad basket of 25 commodities actually dilutes your strategy.
You want surgical exposure to industrial metals like copper, nickel, or aluminum.
Exactly. You do not want your returns dragged down by the agricultural components like lean hogs or soybeans that are bundled into that broad index.
That makes total sense. The market is demanding scalpels, and the derivatives industry is basically engineering them.
They are.
And if institutional investors are demanding surgical precision in what they trade, they're also demanding absolute immediacy in when they trade.
Oh, absolutely. The Catton sources note a massive push to expand operations at designated contract markets and swap execution facilities.
Which, just for context, those are the heavily regulated public exchanges where these institutional trades happen.
Right. And they are seriously looking at extending trading and clearing operations to a relentless 24/7 schedule, including weekends and holidays.
Because they're feeling the pressure from the crypto markets, right? Because
Yeah.
crypto never closes.
Exactly. The demand is certainly there, but operating a traditional financial market 24/7 presents an enormous structural challenge.
Because of the margin calls.
Yes, specifically regarding how trades are cleared and collateralized. In cleared derivatives, both parties have to post margin to a central clearinghouse.
You have your initial margin just to open the position, and then the variation margin, which gets adjusted daily as the value of the contract fluctuates.
Because the clearinghouse is essentially acting as the ultimate guarantor. If a trade turns violently against you, they need to know you are good for the money so your counterparty still gets paid.
Right, they absorb the counterparty risk. But here's the problem. If a massive geopolitical crisis breaks out on a Saturday afternoon and the market tanks, traditional banking rails are closed.
They're completely shut down.
You can't wire millions of dollars in fiat currency over the weekend to satisfy a margin call. So is this push for blockchain tokenization and stablecoins in derivatives basically like trying to invent a high-stakes financial Venmo to handle these weekend margin calls?
That captures the mechanical solution perfectly. Traditional banking takes days to settle, which creates a massive window of systemic risk if the market is moving over a weekend.
Because if a clearinghouse issues a margin call on Saturday and the participant can't deliver funds until Monday morning, the clearinghouse is just left dangerously exposed.
Exactly. But tokenization changes the fundamental physics of the transaction.
By creating secure digital representations of highly liquid assets on a blockchain, like cash or short-term government bonds.
Yes. Institutions can move tokenized collateral in minutes, regardless of the day or time. A financial Venmo makes real-time, intraday risk management actually possible.
So without that instant collateral mobility, a safe 24/7 derivatives market is practically impossible.
It really is.
But here's where it gets really interesting, though. The technological shift isn't just about keeping the servers running on Sundays or moving collateral faster.
No, the Catton report highlights how the fundamental architecture of the contracts themselves is evolving.
Specifically, they point to the explosion of perpetual futures and event contracts. Let's look at perpetual futures first.
Okay.
Thales' olive press contract had a very specific expiration date, right? The autumn harvest. Traditional futures contracts eventually settle.
They do, but a perpetual future has no expiration date. You can theoretically hold it forever.
Which creates a really fascinating mechanical problem, because a traditional future naturally converges with the actual cash price of the asset as it approaches its expiration date.
Right, so if a contract never expires, what mathematical gravity forces its trading price to stay aligned with the actual real-world spot price of the underlying asset?
Why wouldn't it just float away into complete detachment?
The engineering behind the solution to that is brilliant. They created something called a funding rate.
Right, I read about this. It's essentially a periodic, recurring payment exchanged directly between the buyers who are long and the sellers who are short.
Exactly. So if the perpetual contract is trading higher than the actual spot price, the funding rate turns positive, meaning the buyers actually have to pay a fee to the sellers.
Oh, I see. So this financially punishes the buyers and incentivizes new people to step in and sell.
Yes, which drives the price back down to reality.
Mhm.
It is an elegant, self-correcting mathematical mechanism.
So the funding rate acts as an invisible tether, just constantly pulling the perpetual price back toward the spot price through financial incentives.
Exactly. And this innovation has allowed crypto-based perpetual futures to flourish globally. They often offer traders highly leveraged positions without the logistical headache of rolling over expiring contracts every single month.
That makes total sense. But alongside these perpetuals, the report highlights an equally fascinating frontier: event contracts.
Oh, event contracts are wild. They take the derivative structure and apply it to binary outcomes.
Yeah, the Cat and Guide mentions contracts based on political election outcomes, Federal Reserve rate decisions, or even, who will win the World Cup.
You basically take a yes or no position, and the contract functions as a marketplace, pricing the probability of that specific event occurring.
Which has to raise an absolutely massive question for global regulators.
It does. As these event contracts grow in sophistication and volume, the traditional definitions are really being stress tested.
Right, because where exactly is the dividing line between a legitimate financial hedge, pure market speculation, and just outright sports betting?
Exactly. I mean, a media company might legitimately use a World Cup event contract to hedge against a drop in advertising revenue if their home country's team gets eliminated early.
That's a valid business hedge.
But for a retail trader sitting at home, it might just be gambling. It is a very deep philosophical and legal gray area.
Which perfectly bridges us from the borderless technological frontier to how individual sovereign nations are actually trying to tame this beast within their own borders.
The Cat and Guide provides a phenomenal global survey on this.
Yeah, and looking at China, Japan, and Nigeria offers masterclass in how wildly different economies utilize derivatives. So let's start with China.
Okay, so the defining structural shift there was the implementation of their Futures and Derivatives Law, or the FDL, back in August of 2022.
The FDL, and that was a watershed moment because it finally unambiguously recognized the legal enforceability of closeout netting under Chinese law. But let's break down why the lack of closeout netting terrified foreign capital before this law. What did a bankruptcy scenario actually look like for a major international bank trading with a Chinese counterparty?
It was an asymmetric nightmare. They called it cherry picking.
Cherry picking.
Yeah. Imagine an international bank has 100 open derivative contracts with a Chinese firm. 50 of them are currently making money for the bank, and 50 are losing money.
Okay, pretty balanced.
But if that Chinese firm went bankrupt, the bankruptcy administrator had the legal power to cherry pick the contracts.
Wait, meaning they could just pick the ones they like?
Exactly. They could enforce the 50 contracts where the bank owed them money, demanding full payment, but legally default on the 50 contracts where they owed the bank money.
Wow. So the bank's gross exposure was entirely unprotected. That sounds like an unmanageable level of counterparty risk.
It was. So closeout netting solves this by forcing all those contracts to collapse into one single number.
Oh, I see. So if a default happens, you tally up all the winners, subtract all the losers, and arrive at one final net balance owed.
Precisely. The international banks aren't exposed to the gross total of the trades anymore, only the net difference. It is a massive capital efficiency upgrade.
And by providing that absolute legal certainty, China dramatically lowered the risk premium for international institutions.
And we are seeing the immediate results of that structural confidence. Take China's Swap Connect program.
Right, that's a mutual access scheme allowing offshore investors to trade mainland Chinese interest rate swaps, right?
Exactly, without having to navigate incredibly complex onshore account setups. And by April 2025, the northbound route of Swap Connect hit 6.5 trillion Chinese yuan across more than 12,000 transactions.
So they basically built the legal plumbing and the institutional capital just flooded in.
Exactly.
But we have to contrast their embrace of traditional interest rate swaps with their stance on the new technological frontiers we discussed earlier.
Yes, very different story there.
Yeah, because while China is actively courting foreign participation in traditional derivatives, they have drawn an absolute, uncompromising hard line on crypto derivatives.
The state classifies any business activity related to virtual currencies, including derivatives trading, as strictly prohibited illegal financial activity.
It's a totally bifurcated approach, highly welcoming of instruments that stabilize their traditional macroeconomic machinery and completely hostile to decentralized instruments they just can't control.
That's a great way to summarize it.
Okay, let's shift our focus over to Japan because their legal architecture contains this totally fascinating historical quirk. According to the Katten Guide, under the Japanese criminal code, derivatives are technically considered gambling?
Yes.
Wait, why start from the premise of criminal gambling for a foundational financial tool?
Well, under their criminal code, any provision or receipt of money on a contingency basis, staking capital on an unknown future outcome, is fundamentally defined as gambling, which is illegal. Therefore, for a derivatives transaction to be perfectly legal in Japan, it must be explicitly authorized by specific carved-out financial laws, like the Financial Instruments and Exchange Act.
And it has to be conducted by heavily licensed entities, I imagine.
Exactly. If an over-the-counter derivative transaction falls outside those specific legal safe harbors, there is a real theoretical risk it could be prosecuted as a criminal offense.
Wow. But if we look at the historical context, that actually makes a lot of sense. Japan's post-World War II financial regulations were heavily focused on protecting the retail public from ruinous speculation.
Right.
So starting from the premise that it's illegal gambling forces every new financial product to basically prove its economic utility before it's allowed in the market.
And if we connect this to the bigger picture, you see that exact protective philosophy playing out in how they regulate leverage today.
Oh, like with the perpetual futures we talked about earlier.
Exactly. Offshore crypto markets often allow massive leverage on perpetuals, sometimes 100 to 1. But Japan strictly caps this to protect retail investors.
What are the caps?
For retail accounts, leverage is hard capped at 25 times for foreign exchange, 20 times for commodities, and a very strict 2 times limit for crypto asset derivatives.
Wow, just 2 times for crypto. They are aggressively managing the risk appetite of the retail public.
They are. But at the same time, they're highly progressive in using derivatives for public policy.
Right, like in late 2023, the Tokyo Stock Exchange established a formal carbon credit market for J-credits.
Yes, where carbon dioxide equivalent quotas are actively traded. They are building the underlying financial infrastructure to price, trade, and hedge carbon emissions.
Literally turning environmental policy into a tradable, manageable risk.
Which circles perfectly back to the Bloomberg commodity indices we discussed earlier.
Oh, right, because the energy transition requires mechanisms to price carbon and secure industrial metals. Japan is ensuring their markets are equipped for that transition.
Exactly.
Okay, so we've examined China's massive structural reforms and Japan's highly regulated retail protections. Now let's move to Nigeria.
This is a crucial example.
Because the Katten report highlights something vital here. We spent a lot of time talking about multi-billion-dollar institutions and abstract structural laws, but let's look at what happens when these derivative tools are literally the only thing keeping a country's supply chain alive.
The context in Nigeria provides a stark, real-world example of utility. In June 2023, the Nigerian central bank made the monumental decision to float the naira.
Right, they removed the artificial currency peg and allowed the open market to determine the exchange rate.
Which instantly led to massive, crushing currency volatility.
Yeah, imagine you operate a major flour mill in Lagos. You import thousands of tons of wheat from the international market, and your suppliers demand to be paid in US dollars.
Right.
But you sell your flour locally in Naira. If the value of the Naira suddenly plummets against the dollar, your cost to buy that wheat effectively doubles or triples overnight.
While your local revenue stays exactly the same.
Your business is wiped out. You literally cannot forecast your operating costs from one month to the next.
The foreign exchange risk became an immediate existential threat for the entire import-export sector of the economy. So these commercial entities turned to the derivatives market for survival.
Specifically, Nigerian companies flooded the FMDQ exchange to buy Naira-settled, non-deliverable OTC FX futures.
Yes.
Which, let's translate that complex string of terms for a second because it shows exactly how the plumbing works. OTC, or over-the-counter, means instead of trading a standardized contract on a public exchange, the Nigerian company and a bank negotiated a private, custom contract.
Tailored to the exact date the company needed to buy their wheat.
Exactly. And non-deliverable simply means that at the end of the month, they aren't loading giant pallets of physical US dollars and Naira onto armored trucks to swap them.
Right. They just calculate the difference between the contracted exchange rate and the actual market rate and settle the final balance in cash.
It's a pure transfer of risk. They used a forward contract to lock in a specific guaranteed exchange rate for a future date.
Even if the Naira dropped another 20% in the open market, their derivatives contract paid out the difference, perfectly absorbing the financial shock.
And the trading volume reflects this absolute desperation for commercial stability, right?
Oh, absolutely.
Yeah.
The turnover in FMDQ's FX derivatives segment hit a massive 2.85 trillion Naira in May 2025 alone.
Wow.
That represents a 12% increase from just the month prior.
So what does this all mean? It means the basic logic of the olive press from ancient Greece is still the ultimate survival tool, managing the terrifying risk of the future so a business can actually survive the present.
That is the perfect distillation. This $699 trillion market isn't just about hedge funds looking for arbitrage yields.
Yeah.
It is fundamentally about commercial end users, the importers, the farmers, the energy producers. They are using mathematical contracts to keep the lights on during compounding macroeconomic crises.
Which brings us to the end of our journey through the engine room of global finance. We started with Thales in ancient Miletus securing his olive presses.
We did.
We unpacked the staggering scale of a $699 trillion market, seeing how Bloomberg is crafting highly precise, single commodity tools for institutions navigating the complex global energy transition.
But we explored the technological frontier, how tokenized collateral on blockchains is making 24/7 weekend margin calls a reality.
Right, and how the funding rate elegantly tethers perpetual futures to reality. We also saw how sovereign rules dictate market realities.
From China finally embracing closeout netting to court trillions in international capital, to Japan heavily restricting leverage to protect retail traders from ruin.
All the way to Nigeria, where non-deliverable FX forwards serve as the literal lifeblood for businesses weathering extreme currency volatility.
It is a massive amount of complex machinery to take in.
It really is, but here's why you, listening right now, should care about this invisible plumbing. Every price you interact with is touched by this system.
Every single one.
The price you pay for a loaf of bread at the grocery store, the cost of a gallon of gas at the pump, the interest rate on your home mortgage, those numbers are stabilized or, occasionally destabilized by the mechanics of this exact market.
That is the inescapable reality of the modern global economy. But, as we look toward the horizon, I want to leave you with a final thought to mull over, building on our earlier discussion of event contracts.
Oh, right, the political and World Cup contract.
Exactly. We noted that the market is successfully creating derivatives for broad public events. So it forces us to ask, where does this trajectory of financializing risk eventually end?
Oh, are you talking about the hyper-personalization of risk?
Exactly. If the financial plumbing can handle binary outcomes and tokenized instant settlement, will we soon see a world where you can financially hedge against your own deeply personal life events?
Wait, what do you mean?
Well, imagine buying a derivative contract that automatically pays out if your really expensive outdoor wedding gets rained out, or a highly localized event contract that pays out if the specific factory in your town closes down, protecting your local property value.
That is wild.
As the rigid lines between corporate risk management, traditional personal insurance, and outright gambling continue to dissolve, what exactly will the derivatives market of the future look like? Will it remain a macroeconomic tool for massive corporations? Or will it become a highly personalized, ubiquitous safety net, or perhaps a casino for the everyday individual?
It is a wild, slightly dystopian thought, buying a put option on your own wedding weekend. But given how rapidly the technology and the legal structures are evolving, a hyper-personalized derivatives market might not be that far away. Thank you for joining us on this deep dive into the invisible machinery of global risk. Keep questioning, keep learning, and we will catch you on the next one.